Good morning, everyone, and thank you for joining us this morning for our webinar From the Combine Seat to the Office Chair. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters today by using the chat feature at the bottom corner of your screen. You can find that chat feature by clicking on the three dots if you're on your mobile device and selecting chat, or there should be a button that says chat on the bottom right-hand side if you're joining from a desktop. Before we begin, I'd like to introduce a couple of our speakers for this morning. First and foremost, David Widmar and Dr. Brent Gloy, co-founders of Agricultural Economic Insights, and our very own Evan Hahn and Brad Walker, both serving as regional vice presidents of agricultural lending for Farm Credit Mid-America here in Ohio and Indiana. With significant lending and credit experience, Evan and Brad will discuss some of the best practices that you can use as you're winding down your 2023 growing season and preparing for the next. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. So any opinions expressed by the presenters are of their own and do not necessarily reflect those of Farm Credit Mid-America. We hope that you'll join us and send your questions in, and we'll be able to answer those at the back half of the webinar. So with that, thanks so much for joining us. And David, go ahead and kick it off.
Thanks, Mike. I think I'll start this morning for the group, but I'm Brent Gloy, and it is an absolute pleasure to be with everybody this morning. It's still a little dark out here where I'm at in western Nebraska, so my light's a little funky here this morning. We apologize for that. But this is an exciting time of the year because I think most of us are, if not finished, but really wrapping up the harvest, and it really starts almost a new kind of season in the farm business. And you know, as we get ready for Thanksgiving this week, I think we've all probably got a lot to be thankful for. And as we go forward, I think it's an important time to really attack the year end as we come up on, you know, Christmas and the New Year. So as we get out of that harvesting or the combine seat, let's get into that office chair and let's really get a plan to attack the year end. As you all know, there's a lot that goes on at the year end. You know, we've got taxes to prepare for. We've got to make some kind of final input purchases, you know, based on discount schedules and all of that kind of stuff, and really start thinking about the next year. And we've probably got a significant amount of grain to market. We've got to think about capital expenditure plans. Boy, there's just a lot to kind of like get your head around. And so what we wanted to think about today is what to focus on, how to get started, but let's make some plans for working on the business, not just kind of, oh, well, my accountant says I got to spend this much money, so I'm just going to go do that. That's really not the way we want to attack it. Let's attack it with purpose and really set ourselves up for success in 2024 and beyond. So one of the things I think that is helpful for us to do is to really start by thinking about what your capital expenditure plans have been or are going to be going forward. And one of the things that I think is useful to do in this is to just really lay out, okay, what have my capital expenditures looked like in the past? So for instance, what we've got here is just a chart of from 18 all the way going to 2028 of what we spend on capital expenditures. And you can see this operation kind of kept it pretty similar from year to year. And honestly, that's not really such a bad idea. And you can see we've highlighted in blue a couple things where, hey, maybe this is something that's kind of on our agenda for 2015 or for 2023. We're going to have to replace that combine, that tractor that we purchased in 2014, and the planter all the way back in 2012. Maybe time to start thinking about or get a plan to purchase those. So let's lay those out because they're big purchases. They're probably going to impact your cash flows for more than 1 year. So let's start laying that out, because if we don't, sometimes we can get into that trap of, well, we'll just prices aren't where we want, so just going to defer it. We're not going to do anything with it. And we end up with a really big hit in 1 year, which is okay as long as we have planned for it. So really lay these out and take some time to think about it. And then the other thing is to think about, well, how am I going to finance that? What's the trade-off between, using some cash, financing it? How long a term do we want to finance it over? And there's some interesting things that David and I kind of observed in the ag economy, just in terms of what's going on, what your peers are doing. David, maybe you want to jump in on that.
Yeah, to help break this down just a little bit, to help producers think about what they're going to be seeing as they head out to make some of these decisions and use finance or cash to get those CapEx purchases made here in 2023. And one of the things we've noticed is that there's been some shifts in the way that the interest rate markets have been going, but also the terms at which a lot of these loans are being made for. And on the left here, this is what we call the Farm Machinery Debt Service Index. And so it goes all the way back to the 1970s. And we simply say, if you borrow $1,000 of debt for farm machinery, how much is the annual payment for that? So giving you an idea of what that burden is for $1,000 of every $1,000 of machinery debt utilized. Well, in the 1980s, we had really high rates and really short repayment periods. So that equaled a really big annual payment. But as you can see, it's generally trended lower. And when we get back to 2021, 22, 23, these are historically low estimates. And this is despite higher interest rates that we've seen here in 2023. Well, how is this working? Well, what you don't see here is that we've extended these payment terms. So all the loans taken out across the farm economy for farm machinery, those payment terms have been stretched out and out and out and out. And we've even seen this in 2023. So these higher rates we've seen over the last year and a half or so have been offset by more payments. And that's kept the annual payments pretty low. But keep in mind that that trade-off means we're going to have more payments to make over the life of that asset. And that also, adds to more interest expense. And so one of the ideas here to keep in mind is that you might be able to go out and buy that tractor or that planter that we talked about earlier, and the payments might not be as much as initially anticipated given the higher interest rate environment, but use a map like we just showed you there to really map out how those payments are going to play out both in 23 and 24, but also out to 25, 26, 27, maybe even into 2028 as some of these terms are approaching 5 years. So really think about this sort of decision you make today, how it's going to impact your cash flow today, but also down the road. And producers are going to have to really think about how they're going to go about servicing their debt down the road, given this higher interest rate environment, but also longer repayment periods. And that doesn't mean every producer has to, do the same strategy, but just start to think about the trade-offs between purchasing these CapEx with cash up front, maybe some level of debt, maybe a combination of short-term and long-term debt, but really start to shape that up and put that together. One of the things we also want to really challenge you to think about when it comes to CapEx and your plans that you're going to make here to wrap up 2023 is something that we call the Section 179 spiral. And it's something that we want to caution you against and make sure that we think about this and avoid that. So here's how this example plays out. Say year one, there's $100,000 in your business of projected income. You go meet with your accountant. They share this information in early December, and there's a recommendation to go out and make some capital purchases. So let's just say in this example, you go out and make $100,000 in capital purchases. You're able to use this bonus of recognizing all of it through the Section 179 at $100,000. So you get 100% depreciation. You're utilizing debt. So in this example, which isn't maybe reflective of the market today, but maybe there's some deals out there from some machinery manufacturers. But this is a simplified example to help illustrate a point that 0% interest, 3 years worth of payments, you got your taxable income down to zero and your principal payments down to zero. That's a pretty good deal. You don't have to pay, those taxes, and you don't have those debt payments. But we set ourselves up for challenges down the road. We'll show how that plays out. In year 2, same situation, $100,000 in income, $100,000 in capital purchases. We use debt again. We got that taxable income down to zero, but now we have principal payments of $33,000. And then we kick this out to year 3 in year 4, and in year 4 is where things get a little bit tricky. We have that $100,000 of projected income again, and let's just say we pump the brakes and say we're not going to make any capital purchases, because when we get all the way down here in year 4, we're going to have $100,000 worth of principal payments that we've accrued over this strategy across all these years. So we're going to need all of that income to make those payments. And oh, by the way, we still have taxable income. We got to pay taxes on that $100,000. And this starts to get ourselves into a situation where we've disconnected when we recognize the depreciation of these capital assets with when we have that cash activity. And if we start to disconnect those to a large degree, it could set us up to some challenges down the road when all of a sudden we're going to need to have a whole lot of cash to make those debt payments, and we might not have be in a position to recognize all that income to offset all of that. And again, this is a simplified assumption, and I want to make that very, very clear that this doesn't assume interest expense. We wanted to show that this wasn't an interest expense challenge behind here. This was just this disconnect between the depreciation recognition and the cash flow that your operation is going to be using, given the way you're going to pay for this asset. And other simplification here is we didn't assume any income shocks. So you can imagine a scenario here if you got out to year 4. These are the good years where you were making these decisions, and all of a sudden you got to year 4, which is a little bit more challenging. Maybe commodity prices weren't as strong, or the yields weren't as strong, and now all of a sudden you have less of this projected income, and now you have to make those payments with less income than anticipated. So Brent, I want to kick this back over to you as you share the second tip and strategy for producers to get started and making their plans for 2023 to wrap up.
Yeah, David, and I think that Section 179 spiral that you identified is something that can really sneak up on people. So it's important to understand that. But the other thing we want to do is kind of review what happened in 2023. And all of us have to, do this. I mean, you get to the year end, you gotta run an income statement, you kind of look at your cash position, all of that kind of stuff. Everybody has to do it, but only a few people take the time to turn that into insights, and that's what we think is really, really important. Take some time to calculate, your metrics like income statements, cash flow position, update your cash flow, any other kind of maybe working capital numbers or other things in your business that you have, and then kind of compare them to a trend analysis. Where is your business going? Now, one of the really cool things that we all have the benefit of is, you have a financial services officer that's going to do all this information with you and can pretty quickly show you that trend. Take the time to sit down with them and review it and talk about what went right and what went wrong. The other thing, make some observations, write some things down, just go over it. Have a business meeting with your team or with your spouse, and just say, we're not going to talk about what is for New Year's Day dinner today, or what bowl game our team's playing in. We're gonna just really focus on the business today, and really do that. But ultimately, you want to look at what went well, what would you do differently, what do we need to improve on. I think those are all really, really important things for you to spend some time with. And again, sit down with your advisors. If you have them. If you don't, now's a good time to get some that can help you kind of just walk through that and see, okay, here's where we're doing really well. Here's where maybe we need some improvement. But that trend analysis, really, really important. Just see, what's the trajectory of your business. Then the next thing I think that David and I like to do is do what is called kind of a 3 risk exercise. And we wrote an article about it, and this kind of came from David was reading Jamie Dimon or Jeff Immelt's, I guess, letter to shareholders, and he talked about how, hey, one of the things you really need to do is spend some time thinking about the three biggest risks that your business faces going forward. And they could be, systematic, like, hey, I'm worried about what happens if we have lower commodity prices and what is our plan to operate in that environment. Or it could be really farm specific. And I always say, like, David and I write this for the ag sector, and we'll talk about, oh, well, maybe, we're worried about, um, this transition from a tight stock situation to a situation we got lots of stocks and what that's going to do to prices. And so we might write about that for a little bit. But at the individual farm level, that probably isn't the biggest risk. It could be, hey, we have a lot tied up in one employee. He's really, really key to our operation. What is our plan if something were to happen? What is our succession plan? What would happen if something happened to, me in my farm operation, or someone else that's really important to that? So, I think those are the things that are really important, but you just sit down and brainstorm some of those risks and then get a plan to talk for 15 minutes about each one. And David always tells me that, like, okay, commit to talking about it for 15 minutes. And what you're going to find is that 15 minutes isn't going to cover it. You're going to spend a lot of time talking about it and trying to get a plan for how you're going to deal with it. And you'd be surprised how this can change kind of the strategic direction of your operation. The other thing I think you should do, again, meet with, whoever it is on your farm team, whether they have a board or just a top group of people that are kind of running the operation, but sit down and talk with some advisors about this. Get their opinion on what do they think the biggest risks for your farm are going forward, and try and engage with them. And sometimes you're going to have that conversation not going to go very well, or you may not get much out of it. Try and have it with a lot of people until you get to one that you find productive.
And Brent, the real goal from all of this is to chance favors the prepared mind. And to your point is, you might not, this conversation might not be valuable every time you have it, but the more preparation that you have, the more value you can extract when you do line up with somebody who can help you think about long-term commodity prices, how it impact the fixed cost structure on your farm, for example, or who's someone who can help you think about how do you frame up the risk around a key employee around your operation. So you want to spend the time preparing. That way it's not just one of those idle conversations about, yeah, worried about commodity prices like every other farm in the country. Get very specific and tailor this so you have a meaningful conversation for your operation. So this wraps up the first half of today's conversation, where Brent and I shared, 3 strategies for getting you started as you transition from the combine seat to the office chair. Map out those CapEx activities and your plans, review 2023 intentionally, and look ahead to 2024 and beyond with that risk exercise to get very specific and prepare for meaningful conversations. And now, this is my favorite part of the conversation, where we're going to bring in and chat with Evan and Brad. And at the 30-minute mark, we're going to get to all the questions that you all submit. But I have a few questions to get started here with Evan and Brad today. So I want to ask each of you to share a little bit about yourself and your role with Mid-America. So Evan, I'll start with you.
Yes, Evan Hahn, Regional Vice President with Farm Credit Mid-America in Northeast Ohio. I've worked here for 20 years with Farm Credit. Spent a few years prior to that buying grain throughout the Midwest. So a little bit of a grain background too, but born and raised here in Ohio, and Farm Credit got me back here to Ohio, and I've stuck it here ever since. So Brad, I'll let you introduce yourself.
All right. Well, good morning, everybody. David, Brent, thanks for having Evan and I on. I lead our Southwest Indiana team. So the group's made up of 8 loan officers serving 5 of our branch locations in the southwest part of the state. In my 12th year with Farm Credit, so about half of that, I worked with our credit group in Louisville, and then the other half, I've been in a field-based position similar to what I'm doing today. Outside of Farm Credit, I did spend about 10 years working at a couple food companies, Cargill and ConAgra, doing some grain marketing. So similar to Evan. Guess we got a lot of similarities there in our background, Evan. But grew up on a family farm in southern Indiana, graduated from Purdue. I don't really want to talk Purdue athletics today if possible. Well, we can talk basketball, but not football, please. Majored in ag econ, graduated in '02. So that's a little about me.
Well, appreciate your guys' efforts in helping us prepare for today's webinar. You helped Brent and I really focus up that first half of the conversation, and now look forward to you sharing your experiences working with dozens, if not hundreds, of operations throughout your career. So the first idea here I want to pitch out there goes to Evan, and it's this saying that I've heard quite a bit: is the worst decisions made on a farm are the ones managers didn't make. So as a lender, put your lender hat on. Mean to you, and can you elaborate a little bit on it?
Yeah, and I guess when I think of that quote or that kind of idea, it's, farmers sometimes will get caught up in what others are doing or what they hear other people are doing or other people tell them to do. And for the financial side of it, a lot of times it's year end. We'll talk to them and they'll say, well, I got to talk to my accountant and see what I need to buy. And that is a decision that ultimately they make, but sometimes it might not be for the best reason. And that's where I just really encourage customers to sit down. I thought that CapEx example that Brent went over was a great one, just to think through and map out what you do today will impact your operation for the next few years in terms of payment and cash flow. Just really encourage them to think through that and think about, what do I need versus what do I want versus what do I have to operate my business. Cast a wide net, go ahead and have those conversations, bring those trusted advisors in, but ultimately make that decision on their own and own it and move ahead with it.
Yeah, we put these plans into place at the beginning of the year. We execute on them. We have a successful year. And then you get to the last 6 weeks, and all of a sudden it's sort of this sprint to try to get your tax bill down to zero. It's a lot of work to there's a lot of strategic work and planning that goes into sort of a last minute scramble. So that could be a bit of a disconnect there between the complexity of your business and the plans you make, but also the simplicity of maybe some of the approaches we have at the end of the year. Got another one for you, Evan, here. Everyone has to do those year-end activities that Brent mentioned, but what percentage of farmers leverage those must-do activities to glean insights and value for their operation? So taking it beyond just preparing those records and to turn over the accountant and turning into meaningful insights about their business, are there a few best practices also that they can utilize?
Yeah, and I really encourage them. It's an enormous opportunity for them to sit down at year end and really kind of clear their desk. The weather's crappy outside. Spend some time, like you said, talking with your business partners, your spouse, and reflect back on their business. I guess the way I look at it is, you don't hook up the planner and drive to the field and say, well, I'm going to plant today. Whereas it feels like at year end, it's year and a half to get this done, and really spend the time to think about it. As you're looking to plant, as you're looking to harvest, you're always looking at trying to maximize your opportunity. And I really encourage customers to do the same with their year-end financials. This is their opportunity to maximize their knowledge of what the financials are, what they want to do in the coming years, and how the last year shaped up, and really the impacts of some of those decisions that were made at previous year end. How did they play out? How they want to adjust that going forward and make any tweaks.
Yeah, I really like that analogy of how much time do we spend preparing for planting or harvesting, and how much time do we spend preparing to submit our financial statements to our lender or to our accountant. If you flip that around, it might be scary if we spend as much time, the time we spend preparing for our taxes, we spend preparing for planting. That would be a little bit of a scary management practice, but it's a helpful way to think about that. Brad, you helped us think a little bit about the importance of benchmarking when it comes to end of the year activities and reviewing our financial success. What are some of the tools that FCMA has available, and how can the FOs help?
Sure. Yeah, I'll talk a little bit about how we use our benchmarking tool, AgCompare. But I guess first, just thinking about coming off of harvest here recently, a lot of the benchmarking discussions can become very production focused. So, a lot of field visits with customers, obviously out harvesting a crop, we're looking at yield per acre. They're thinking ahead to next year. Comparing different seed varieties, doing soil testing across farms. And I think that's the part that can get a lot of emphasis. I'm not going to say that's always the case, but I think we have an opportunity to really focus on the financial aspect when it comes to benchmarking and understanding what is the financial health and risk-bearing ability of the farm. So there's many that do a really good job with it. It's not a one-size-fit-all, but I do think that it is an opportunity for us just to make sure we're staying balanced. And kind of like you alluded to there a minute ago, are we spending the same amount of time preparing taxes as we are preparing to plant? Just making sure we're staying balanced on both sides of the business. So using benchmarks really allows us to identify strengths. So what gives us a competitive advantage, but also understand any blind spots that may exist in the business or potential weaknesses that we don't really know about. So there's a lot of data out there, obviously, different ag organizations such as AEI or university data. It can almost become overwhelming in like how you would go about benchmarking. But a few ways we benchmark here at Mid-America. First, we look at historical trends. So where your farm is today versus where you've been historically from both a balance sheet and income perspective, and what are the decisions that played in to any movement in those trends. And Brent touched on it earlier. What is the trajectory of that farm business? We also have a lot of ag knowledge within our team. So we look at industry standards, both our loan officer team and our credit team in Louisville. We've got industry specialization within that credit team. So we're able to provide feedback on just how things stack up versus the industry. But I think what most people probably think of when it comes to benchmarking is that peer comparison. How do I stack up versus similar size farms in my geographic area? So our Ag Compare tool, it does focus on a few areas. I won't go into great detail on each one, but our core underwriting standards, debt coverage ratio, solvency, or sometimes referred to as owner's equity, and then liquidity, which is a measure of working capital compared to the farm's revenue, and then a couple supplemental ratios, the fixed cost ratio. That gives us an idea on what the land and equipment expense is, both from a loan payment and rent expense perspective, and then variable cost, including the big three in seed, fertilizer, and chemical, plus any other remaining expenses. So I like how Brent said, turn them into insights, and that's what we want to do. We don't want to just throw a bunch of data at a customer and say, all right, here's your Ag Compare tool, but help them identify what those insights or key takeaways are on the farm. So any producers on the call today that haven't had an opportunity, I'll just throw this in there. If you haven't had an opportunity, I would encourage you to talk with your farm credit loan officer about Ag Compare. I think it could be a really insightful tool in your farm operation.
So, Brent, I'm gonna kick it back to you for another question. We've kind of observed, Brent and I have observed, there's two different types of lender relationships. Those that talk with their lender only when they need something, and those who work with their lender in that trusted advisor role, where there's sort of this strategic element of planning and projecting out into the future. Can you talk about the differences from your perspective, and what's the value of being that being a lender that can provide a strategic partnership? Brad, it's kicking that to you.
Yeah, sorry. Yeah, I think that a lot of times it is really just focusing on more of the relationship and being that strategic partner outside of a loan transaction. So tech has become more and more prevalent. I do think that lending is still a people business based on trust and relationships. So as you think about any farm operation, I think whether formally or informally, there's a board of directors, and whether that be your agronomist, your accountant, legal counsel, tech expert, what have you, there's that circle of trust within the farm. And that's really what our lenders here for our credit look to be, our loan officers. We value ourselves on knowing the industry and being a financial professional for our customers. And really the goal is just to create awareness. So create that financial awareness so customers know where they're at, going back to earlier where you were talking, David, you were talking about just the CapEx and planning that out. Customers know what they're able to do and maybe what they should avoid, and really just unexpected, just avoiding any unexpected from both parties. And that allows us, like when a customer comes to us, just to really be a consistent and reliable lender. And at the end of the day, that's our goal, just to be that trusted partner. So I think things like, competitive rate, cooperative values, obviously patronage, all those types of things are are very tangible benefits of working with us. But I really think just having that deeper relationship, being that strategic partner, providing feedback outside of a loan transaction is what we're after.
All right. Well, I have one question. I'm going to give both of you a swing at it. And my last question before we get to all the participant questions is if there is one piece of advice that you'd place on a billboard for thousands of producers to see here in November 2023, what would that advice be? And Evan, I'm going to kick it over to you first.
Sure. And I guess this may be just even broader than producers in the ag sector, just kind of in general. And I don't know who to attribute this to, but I've heard a lot of different times. And it comes back to the worst decisions sometimes are made in the best of times. You kind of get rose-colored glasses, think we're in a new normal, or we've had a couple good years in a row, and it can't get worse than it is right now, and make some long-term decisions that have long-term implications when things aren't going as well as they are right now.
Brad?
Well, mine isn't near as profound as Evan, so I need Micah or somebody in the marketing team to help me spruce this up a bit. But just thinking about the importance of working capital, just build and preserve working capital, and I'd have my marketing team put a spin on that for a billboard. But obviously, a lot of cash is still out there. We all know cash is king. We're also seeing slightly increasing debt in the ag sector, as well as the interest expense increasing. Seen a lot of cash purchases here lately, whether it be equipment or land. So we all know ag is cyclical, and my advice or recommendation on a billboard today would just be the importance of preserving the working capital that's been built over the last few years.
All right, Evan, Brad, thank you so much for your insights so far. I know you're going to stick around and answer all the participant questions that come in here in the next few minutes. But at this point, I'm going to kick it back to Micah. Micah, we reached our 30-minute point, and we're ready to go to the next phase.
Well, thank you guys so much. I appreciate it. If you do have any questions, feel free to send those in to the bottom right corner of your screen under the chat feature, and we'll get them answered. We do have 3 questions that came in ahead of time from guests that had registered. The first one is kind of long-winded here, so I'm going to try to break it down for you, Evan and Brad. And it's really about capital or CapEx plan and the idea of investing now while times are still good versus kind of kicking the can down the road. Do you have any thoughts on when to pull that trigger, or is it dependent on every operation? What are your thoughts on that?
Yeah, I guess I'll jump in first. I mean, if there's really a need, then looking at that and looking at alternatives and just deciding, all right, is it now the best time? I mean, we've been in a few years here where it seems like everything's more expensive the next year than it was the previous year. Will we always be in that phase? I wish I had that crystal ball. I would hold off buying everything that I need personally until that time. But I guess my advice there would be don't wait until it's past the point of its usefulness. If you've got a piece of equipment that is just not cutting the mustard for you anymore, you can't work efficiently, you probably waited a little bit too long. So you're never going to know ahead of time whether you made that decision at the right time or not. But if you're making it from a need standpoint versus a want or a tax mitigation standpoint, I think you're still making a better decision that way.
Yeah, I think it really depends. I hate to answer the question that way, but really our goal is to work closely with producers where they have an understanding of that fixed cost structure. So if they're in a position where their cost of real estate and cost of equipment is relatively low, and to Evan's point, if there is a need on the farm, by all means, like Evan, I don't have the crystal ball to know what equipment prices will be down the road, but I know ag is so capital intensive, and I think a very important part of the farm is just making sure we're maxing the use of each piece of equipment, getting that maximum return on the farm. So as for what the future holds, I may let the economists answer that piece of it, but I think, really just has to be customized to each individual farm.
Well, I think you guys gave great answers, and the one thing we know is it's really hard to time these things perfectly, and if that's what you're trying to do, it's really hard to do it. And I think the best advice, or what I try and do, is balance some consistency in there so that you're kind of doing things on a regular basis so that you're not, all in at the wrong time, I guess is probably um, one way to think about it.
Brent, I'm going to keep this next question with you. When are you and David planning to sit down to think about kind of the top 3 things for 2024 in the ag sector? When can the people expect that?
Well, David is probably the guy to answer. Or maybe he asked that question to get me going on it. But yeah, we're doing that here soon. So, you know, we tend to write those from the bigger kind of macro perspective. And as you might imagine, there's a lot of different things going on right now. You got a lot of macroeconomic uncertainty, more so than we've had at kind of any other time in probably most of our careers. We got interest rates at levels now that we haven't seen for a long time. So a lot of things to think about. David, I don't know if you have any more ideas. We'll probably have that coming soon, huh?
Yeah, look for it around the beginning of the year. The first thing we always try to do in December is recap the biggest stories in the farm economy for 2023. And I think that could be a really great starting point, as we mentioned in today's webinar. What are the biggest stories that you all had in your operation uh, over the last year, and start thinking about what are the biggest things that you're thinking about for the next year?
Yeah. I think the shifting in the supply, kind of the commodity balance sheets too is a big story. It's starting to look a little different than it has for the last few years, and so we're kind of going from this time of pretty tight to maybe not as tight, and that I think means some things for prices going forward. Of course, that can all change with 1 year weather too, but um, the stance I think has changed a little bit.
Brad, I'm going to shoot this next question your way. It says, appreciate benchmarking to other farmers similar to the size of their operation, but what about benchmarking to the grower's own history? What recommendations do you have on that front?
Yeah, I think it really depends on the industry, and I don't know if that question's coming from a grain or livestock producer, but we do have some metrics outside of our core underwriting standards that we'll look at, whether that be, interest expense ratio, operating debt per acre. There's a multitude of things that we look at. So again, I think we just want to tailor that to the particular sector of the ag industry that we're referring to. And Evan, I don't know if you have anything to.
Yeah, I guess I was going to jump in at the end of it. It's a great question, but that it kind of ties into what we're talking about is set some targets now at the year end, and they can be your own targets. They don't have to be ours, or we can help you work through those, and then get to the end of the year and look and see, okay, how close did I come? What management decisions did I make? What production issues, good or bad, happened to help me get there? What was the weather? It's really just taking that time. If you can't benchmark against the industry, you absolutely can benchmark against yourself. Well, we got to start with some assumptions and some projections and shoot for the moon. That's fine. If you fall a little bit short, that's still okay. But you can't really benchmark yourself if you don't start with that good base of information at the beginning of the year, and then just making it an annual habit and sit down, whether we're a part of it or not, we're happy to. But sitting down with your own management team or family and looking back over the year and saying, what happened, why did it happen, what was the outcome, and what are we going to do different in the future?
The thought that really came to mind for me when this question came in was really our growing forward customers and how important we stress the year-end balance sheet, right? Because just as Evan mentioned, it all starts with having that quality data to be able to make those analysis and be able to kind of do that look back. And so if you take anything away, I think that's really the foundation or the keystone is to start with that quality information on December 31st and have that consistently.
That's a
David,
good point, Mike. I think there's a lot of really positive, just fundamental things that we work with our Young Beginning Small Farmer program on. That year-end balance sheet, the business plan, all these things that we've kind of addressed today that, an up-and-coming farmer makes it priority, and then maybe as time goes on, it becomes a little less of a priority. So yeah, a good reminder there.
David, I had a question around the interest expense on your slide that you had here just a little while ago, talking about the amount of debt that you have over a time period. Do you want to mention anything on that front?
Yeah, I think question came in, a chance to clarify. The chart was showing the life interest expense over the life of the entire loan. And what's unique here is that we have much higher interest rates on that machinery being reported by the various Federal Reserve banks. And also this really long payment term. So we're sort of got this trade-off where the annual payments have stayed really low, but those extra payments are also adding to that interest expense that's earned or accrued over the life of that loan. So this is where producers are going to have multiple lenses as they're evaluating these decisions. It's sort of short-term, payments haven't changed that much. Long-term, there's a lot more payments, and that's going to result in a lot more interest expense accrued. And we're probably not going to feel the pain of that until 4 or 5 years down the road, when all of a sudden, it's time to replace that combine that we bought just a couple years ago. It's time to replace all these things, and now we just don't have enough payment capacity to cover all the things that we used to cover five or so years ago. So yeah, that last chart, just to reemphasize, is the lifetime expense of all the interest expense in that loan, not just a single year.
Thank you for that. Brad and Evan, I want to close this out with one kind of final question or thought that came in is, what are you talking to your teams about? If I'm a customer and I sit in your region, what can I expect from your team the next time they come to the farm gate as far as thoughts as we close out 2023 and prepare ourselves for 2024?
I would say a lot of what we've discussed here today. I mean, a lot of that same conversation happens internally. So we're preparing to do our annual financial updates with customers. We have certain customers that we know are very interested in do that, and we make it a point to meet with them annually. But if there are customers that want to be more proactive, I would absolutely encourage them to talk to their loan officers. But I hate to just say like ditto, but everything we've talked about here today is very much going on internally here just to make it a priority.
Very similar to Brad. I mean, I hope when my team's out there, they're asking questions that nobody else is asking of the producers, and not to poke at them, but just to get them to think and spur a conversation, get them to think a little bit differently, and really invite us to be part of that trusted advisor group. Doesn't mean we're always going to say yes, doesn't mean we're always going to see eye to eye, but just having those conversations and opportunities to work through situations just results in a better outcome for the producers.
And again, I'd say doing all these things just outside of a loan transaction. Failed to mention that earlier. I know I touched on it earlier in the discussion, but just trying to avoid that reactionary, like, well, there's nothing really. I'm renewed for the year. No CapEx coming up. No farms I'm interested in. I'm not going to do that this year. And we'll see that where we have a good set of data where we're getting year-end balance sheets, and then all of a sudden, oh, there was no borrowing need, and next thing you know, we're sitting in April and that year-end balance sheet wasn't updated, and it's nearly impossible to go back to December 31st and recreate grain inventories and receivables and payables and all that once that's passed. So, yeah.
Well, thank you all very much for your time. We're going to close out today, and I think the final message that's really been tied throughout is that we hope that the customers on the call really lean into the team that we have, the boots on the ground that we have out in the field. We want to be a resource to our customers, and more than just whenever that borrowing request comes in, right? We want to be able to have these conversations at year end and provide value beyond just lending you money. And so we hope that you'll take us up on that. We've got a great group of team members out in the field ready to answer those questions and to be leaned on. So thank you all so much. We hope that you have an excellent holiday as we near Thanksgiving here and head into closing up and getting equipment cleaned up and putting back in the shop as you plan for 2024. So this recording will be sent out to all registered guests as well as posted on our website at fcma.com. So as you think about some of the things that were shared today, we hope that you'll revisit us online. Until next time, we'll see you then.
Thanks, Micah.